Has the real estate investing game changed forever? And what are the implications to do-it-yourself investors? Are Canadian cities on the edge of real estate oversupply? We talk about this and much more on this episode.
And how about why are thousands of workers being forced to the office? And what does it really mean for families and investors? And everyone's talking about immigration. But is it enough to save overbuilt markets like Edmonton and Calgary? And finally, the Canadian economy is slowing, real estate is definitely shifting, and investors need answers. Let's unpack it, JG.
Ladies and gentlemen, welcome to episode number 71.
Let's rein it in. Just a polite ask to like, to subscribe, to comment. We got to get those algorithms fired up. We want to hear from you. Let us know.
All right, Patrick, let's get this party started. I think we should talk about the first topic of conversation, which is quite fascinating. And it's all about whether or not real estate investing has changed, how it has changed, and what are the implications for do-it-yourself investors. I mean, Patrick, you cut your teeth in this very market. You're a do-it-yourself investor. I'm a do-it-yourself investor. You have personally, and I have personally trained, hundreds, thousands, tens of thousands of do-it-yourself investors. Like, is that game dead forever? I mean, what's going on here?
Well, I think the game has changed for do-it-yourself investors, likely forever. And certainly, if not forever, for a very extended period of time. Let's face it, the headlines are driving people to the sidelines. Interest rates are freaking people out. A lot of individuals are in trouble because they played the speculation/gambling game in the pre-built construction, pre-built condo market. And, now they're paying the price for it. And that alone is keeping people, stuck on the sidelines. So let's face it, going forward, I think it has, in fact, changed for an extended period of time. Do-it-yourself investors who want to get in the game are going to be challenged because it's going to take a lot of work. Let's face it, over the past several years, let's say even the past 20 years, basically you threw money up against the wall in the world of real estate and it stuck. Not anymore.
So what do you think has changed then, Patrick? Like, what is the rule that changed? What is the thing that changed? Like, what changed where the average do-it-yourselfer just can't make it work anymore? Or in what you're saying is, it sounds like they can, but it sounds like it's just a whole lot harder than it used to be.
Oh, well, it is harder. But the other side of it is, JG, is that a lot of individuals who are in the game, we talk about it all the time. One of the reasons we started this channel was let's always look at the data. Let's not be driven by emotion. For the past several years, many years, let's call it since 2008, interest rates are low. Real estate prices only ever go up. All of the narratives that were out there. And basically anybody could get in the market. The banks were lending, again, with even availability of units up until, or properties up until 2022, 2021, when the pandemic locked everything down. The point is that now all of that has caught up. People were borrowing a lot of money. People were speculating in the market. Of course, we know the condo market, that speculation market, the big speculation market has melted down. And so anybody who wants to invest now has to get through the fear, has to get through the clutter, has to look at and really do diligence on properties to make sure they cash flow because they're harder to find. Opportunities are certainly showing up by motivated vendors, JG, for anybody who's willing to do the work, but it's not easy. It's gotten more difficult. And now people are just saying, no, I'm out. I don't know where this whole real estate thing is going. Interest rates aren't going to come back down. The economy seems to be imploding. I mean, there's a lot of negative, not just headlines, but even the data is a little bit suspect in terms of, do I really want to lean into this? Do I really want to put my capital into real estate? And so that's taken most people out of the market. I would say it's melted down by 90%.
Okay, I agree. It's shifted for sure. Let me put a different spin on this. I agree. In many ways it's harder than it's ever been. I'm not sure in all the ways you're talking about, but in some ways it's definitely harder than it's ever been. Financing is incredibly challenging. Like right now, today, it's incredibly challenging. Is it going to stay like that forever? I don't know. We'll see. Time will tell. But one of the things that's definitely different, and I think this fuels the change you're talking about, is man, there's so many more great options today than there was back then, at least from my perspective. Now you can correct me if I'm wrong, but there's some phenomenal REITs today. There's so many great programs out there, so many great REITs out there. There's so many great opportunities out there for people to put their capital to work in real estate without having to do the work. Back in the day, if you wanted to put your money into real estate, like, yeah, I bought a property, it was like, it was the way to go, and there wasn't as many alternative solutions, let's call it that. Nowadays I see a lot more alternative solutions, and let me tell you, those alternative solutions, a lot of them provide fantastic results, 12%, 15%, 18% yields. That back in the day, to get those kinds of yields, you had to invest in the actual real estate itself. But I find the industry's grown up a lot. I find the industry's gotten a lot more sophisticated, and it's offered up some alternative investing products, let's call it. Not all great, definitely can't endorse them all. But Patrick, you and I personally know many people who do run these kinds of funds, and man, they crush it. They do really, really well. So I guess the question that I'm going to counter with is, do people even want, or should people actually even own the actual real estate? If ultimately at the end of the day, what you're looking for is, you're looking for a return on investment, you're looking for growth of capital, and you're looking for financial freedom so that your money works harder for you than you work for your money. And if you can get that without buying the actual real estate, is that a bad thing? It's a good question.
Well, it's a great question. And your point is 100% valid. I mean, we've always said that there's no bad times to invest in real estate. There's just the wrong strategy given what's going on economically. So to your point, I think private REITs, way better than public REITs, but I think private REITs that you do your diligence on are definitely an opportunity, because at the end of the day, JG, we both believe, and the data supports, that real estate is still an asset to hold. We've talked about it many times. Devaluation, decoupling of fiat currency, loss of value in Canadian dollar, all of the things that say, where do we put our money so we can stay ahead of inflation? Understanding that inflation, what we call the CPI, or many call the CP lie, is we are so far behind in the dollars and cents of it, that how do we stay ahead of inflation? We have to invest in those stores of value, hard assets, real estate being one of them. Now we have to change the strategy. But here's what back to what I said before, is so many do-it-yourself investors are driven by emotion. The highs and the excitement of a boom cycle, and then the fear that's driven by a slump cycle, like most cities
So,
are going
but
into.
I agree. Well, hold on. I don't necessarily. I agree. A lot of people are motivated that, Patrick. But let me just play devil's advocate for a second and say, like, other than social media, and there's a lot more hype today because of social media. Everyone's a genius, and so on and so forth. So people get a much more emotionally involved today than they did, in my opinion, 20 years ago, when people were on their Blackberries and they didn't know what Facebook was. Is that the thing that has changed? Because you can't say that people were always emotionally driven with real estate. I mean, it's the same thing. When times are good, people think it's going to go on forever. When times are bad, people think it's going to go on forever. And in both cases, they're wrong every single time. What's changed this time? Okay, there's much more social media and access to information. I'm 100% on board with.
We haven't had a we haven't had a recession in 20 years in Canada. I mean, we've had slowdowns, we've had pullbacks. We had 2008 to 2010. Alberta got hammered, and we've had moments in time where it was a little frightening. But we haven't had what we've got going on right now, which has become a global phenomenon. And so certainly the headlines are definitely a big part of what's driving this, and they're real. I mean, there is some real data out there that for most will be very frightening. They see it as potential job loss, for example. Go to your point, getting financing is very, very difficult. And if you aren't surrounded by the right people, the right mortgage broker, et cetera, buying that hard asset, owning that title, to your earlier point, is something that's very difficult to do. So, there's just the fear around that side of it. Job losses, we hear, back again, we finally got a government that's been doing nothing. And then now on top of it, we've got the narrative that say, well, everything's, Trump's fault. It's all about the tariffs. Well, yeah, I'm not going to say that the tariffs don't have an impact, but I mean, there's been a dozen years of poor, and we're going to talk about this today, Look at the productivity or the lack of productivity in Canada. Let's face it, we are not productive. We haven't been. Real estate has made up a huge part of our economy, as has consumerism, both of which are shutting down. So the fact that we're probably in a recession. I know some would argue with that. The numbers say, well, we're not, but we really are. If we really look at the numbers, Ontario particularly, JG, you live in Ontario, so you see it closer than anybody. And you're not a do-it-yourself investor. I mean, you run a business. You're in the trenches every day, developing and in the real estate world. I mean, all you have to do is talk to the few hundred properties that you manage, the owners of those properties, and they're probably kind of a little bit nervous. Are they growing their portfolio, or what are they doing? So we start to see that it is really for the faint of heart. This isn't the game they want to play, but they're going to run into the next problem, which is they're going to be sitting on cash, and it's getting eaten away between taxflation, and let's face it, our taxes are crushing most Canadians, and then the cost of living. So as much as they say, well, the CPI is 1.7, it's under 2%. If you look at that part of it, and only in that aspect of it, you start to go, okay, well, inflation's under control. They should be lowering interest rates, at least the variable rate. But then we have to deal with the fact that food costs are up, shelter costs are up. The only thing that is down is fuel costs, and that's because they dropped the carbon tax that wasn't supposed to drive inflation. I mean, so it's a very confusing time as well for most people if you don't look at the data and then understand even what to do with it. So that's kind of where it's at right now. And so from that perspective, do-it-yourself investors are off. They're just gone, and the condo market's shut down, which made up a lot of investors. JJ.
Well, that's what I was going to say. A lot of people do they do it yourself investing through condos, and that market definitely has slowed down, especially in the GTA area, Vancouver area, so on and so forth, for sure. So yeah, no, I got you, Patrick. And like I said, I think the real question people should ask themselves is do you need to do it yourself anymore? Like, is there a better way to do it? And I think if you look around, there's more options than ever today to put your money to work in a variety of asset classes, including real estate, through some great products.
Right. But for this conversation, in the context of do it yourself, in the what we've always looked at, do it yourself, or go buy a duplex, or to me, investing in a pre-built condo has never been an investment. That's always been speculative, but that's my view of that world. It's always been my view of that world. And, many years later, it proves to be the truth. Now, having said that, a lot of people made a lot of money in that space while they were playing it, but the music stopped and there was no chairs left. So anybody who got in late, they're paying a price.
Yeah, if you took that bet and you made out good while you had it, perfect, and you got out when the time was good on you. Fantastic. That's great. That's I'd be careful to do it twice in a row, but anyways, you did it once, good on you.
Exactly. Back to your point, REITs and stuff like that are still still a great way to put your capital to work.
The other thing that has definitely changed, Patrick, 100%, and this is when you started investing in real estate, the average person who made 50, 60, 70 grand a year, which was a great living wage back then, 20, 25 years ago, you needed to come up. You were buying a property for 100 grand, and you had to come up with 5 grand or 10 grand as a deposit, or 20 grand maybe as a deposit. Nowadays, you want to buy a property, you got to come up with $200,000. Like, somebody was asking me the other day, JG, how much money do I really need? I said, well, listen, you can probably do something with about $100,000, but under 100, you should just go put your money into other real estate products, not the actual real estate itself, because for 30, 40, 50 grand, you can't do much in real estate, if anything.
Nope, you're right. That game has changed. So all to say this, has the real estate investing game changed for do-it-yourself investors? 100% it's changed. Has it changed forever? Who knows? But it's certainly changed for a long time into the future.
Now, Patrick, you talked about CPI. You talked about the fact that the printed CPI is coming back down from a percentage perspective. We know that that's just means the percentage over last year. So the growth is slowing. Instead of growing by 4 and 5 and 6 and 7% year over year over year, we're down to 1.7%. But the gains are still there. I mean, the cost of living is still up. And I think that's what this chart shows, Patrick. The actually only thing that has gone down in price is transportation, because the cost of fuel has come down, and also interest rates on vehicles have come down, and that's all part of that.
There's a couple things that have to be considered here. It's funny is that everybody's looking for affordable housing, and that's, of course, that's been the topic of conversation for a number of years now. But consider the fact that housing prices have dropped from the highs of 2022. They're back into that 2018, 2019 range of pricing, but here's the other side of it. As much as some housing prices have come down in some regions, you got another fundamental is that the disposable incomes or discretionary income, disposable income has been eaten up by the cost of living and by the increase in tax. We don't talk enough about taxation. I mean, as Canadians, we bitch about it, but we really don't shine a big light on the fact that it's well over 40% of our income goes to some form of tax, not just income tax. I'm talking GST, I'm talking about provincial sales tax, I'm talking about the tax we pay when we go to a medical appointment. I mean, we get hammered time and time again. And the latest data shows it's well over 40% of our income is in fact being driven or is being eaten up by some form of tax. Well, what does that leave over? Give us left over. And then on top of that, we've got food and shelter costs going up. We don't have the disposable discretionary income that we once had. So people are just having to pull back. So it's that self-fulfilling prophecy of consumerism, which was a big part of our economy, real estate, which was a big part of our economy, all of which is kind of coming to a significant and notable slowdown.
Now, Patrick, I want to stay on this theme of kind of economics for a second, because, and this is kind of a bit of a hint to me that we're approaching the bottom. I'm not saying we're at the bottom. I'm saying we're starting to approach the bottom, is when all the media outlets start talking about how painful it is. Now, it's working its way through the system. You always talk about this, how it takes 12, 18, 24 months for numbers to work their way through the system. And the conversations you and I were having 12, 14, 15, 16 months ago, finally, the National Post is now talking about it, right? And now I know, okay, it's working its way through, and we're on the back half of it. I'm not saying we're at the bottom. I'm just saying that it's working its way through, and this is one of the ways I watch that.
Yeah, it's like it's the old case of, we hate to tell you, we told you so, but we told you so. To your point, we've been talking about a lot of this stuff for as much as 2 years, definitely a year and 18 months, because you could see it coming. And, we will talk about employment in this as well, and understanding that, the actual employment levels are at the lowest they've been for, I think, almost 30 years. So unemployment is going up dramatically. It is going to continue to get worse. And sadly, that's because of the construction industry is going to continue to get beat up. Now, not just construction. So we've talked about this before. The condo market in Toronto is I mean, I don't know another word for meltdown. We've talked about it before, but it's come off the rails. It continues to come off the rails.
Can I give you a different word, Patrick, that you
Sure.
might want to put in? Let's say shit show. It might be a shit show.
It is a shit show. It is 100% shit show. So, with all of that, it's, sadly, there's a price to pay for that. Developers going broke and going out of businesses, and the number of foreclosures or power of sales, depending what term you want to use, they're through the roof and continuing to rise. People are just going to lose and continue to lose jobs. Ontario is definitely going to be and feel the brunt of this economic downturn, followed by British Columbia. Western provinces, as in Alberta, Manitoba, Saskatchewan, and Quebec will probably do fine, just the nature of Quebec. But Ontario, I mean, is our biggest population in terms of the impact it has overall economically, and it's going to continue to get hit, and we have nothing to replace it, JG. So I know we're jumping around in the conversation a little bit, but when you go back to the statement from Carolyn Rogers with Bank of Canada, in case of emergency, break glass, and the emergency was lack of productivity. We have not shifted one iota in terms of our productivity. So our GDP has been driven by real estate, as much as almost 8%. I mean, that's huge numbers. So our GDP driven by real estate, which is now coming off the rails, and by consumerism driven by immigration, which, as much as they say they've slowed it down, they've just slowed certain sectors of immigration down. The point is this: everything is slowing down, and it's going to continue to slow down through 2025. Now, the good news is, I think interest rates by the end of the year will kind of come down. There might be if that's a light at the end of the tunnel.
I feel like every time we talk about interest rates, it's like I feel like they're schizophrenic. It's like they're going up, no, they're going down, no, we're good. Oh no, they maybe they could, it's like, and even the experts who this is their job is to predict where interest rates are going. I mean, they can't. No one is nailing it, that's for sure. But investors like you, like me, like the people watching this show, we have to make mortgage decisions. I renewed 5 mortgages last month alone on various properties, and it's like these are not easy times to make this decision. Do you lock in for 1 year? Do you lock in for 3, 5? Where are you at? The best advice I can give people is not whether you should do it or not, but after you make the decision, don't beat yourself up. Move on. Like, you made the best decision you could at the time, and after you make the decision, lock it away and walk away and leave it. Revisit it at the time, because otherwise you just drive yourself nuts, especially when you own multiple properties like you and I, Patrick. You're never going to make the perfect decision on all of them all the time. So you take your wins where you get them, and then sometimes you don't have the wins.
Yeah, and I've got 3 that I'm renewing next week, and I have to make those calls, right? Do I go 3-year, 5-year? Do I stay variable? What do I do? Bond yields are down a little.
So what are you going to do? What are you going to? Let's talk about it. What are you going to do?
I don't know if I'm a good comparison, because my loan to value on these 3 properties coming up is like 20%. So, I mean, these are very, it's like, okay, should I, I talk to my accountant, should I just write the check and pay him off and not worry about it? And then we have that discussion, is that, the best strategy and liquidity and all the things. But I mean, it's not a ton of dough on these particular 3 properties. And so I can't really, I don't know what I'm going to do. Like, there's a part of me that's going, what should I do? But I mean, let's put it this way: if I lock it in for 3 years, they're more than paid for at the end of that 3 years. So does it really matter a half a point one way or the other? Not really. Yeah.
But that's important, Patrick, is does it matter? And a lot of real estate investors beat themselves up. And the answer is not really. It's in the long haul, in the long-term picture, the whole thing, it's not really going to matter, because at some point, like, look at back in the in 2020, 2021, 2022, 2023, Patrick, when the rates were super low. I mean, some of my mortgages were like at 1.2%. And I was like, this is the best. So like, that was a huge win for those 3 years. So, I'm definitely giving some of those wins back right now. That's for sure.
Yeah, but here's the thing. I think that given the economic conditions, and the bank is always slow to respond. Bank of Canada is always slow to respond. We've talked about it multiple times. But I think by 2025, we will see a variable rate drop. I don't know if we'll see a half a point, but we will see a quarter. I'm pretty confident in that for those who want to, hang on and see it. I think I'm pretty confident in that, but I mean, who knows? And there's a lot that can happen between now and then economically as well that may change that whole view. Hell, maybe they'll go up,
No, but I want to touch, I'll say one last thing about interest rate, because I know there's a lot of investors that struggle with this decision. So if this could be useful to you, then I hope it is. But there's one particular mortgage, Patrick, I renewed. It was a pretty significant mortgage. It was like a $1.5 million mortgage. And it was at 6.5%, I believe. Was it 6.5? Roughly, it was in the 6s. And I was able to get this mortgage, and if I remember right, I was able to get this mortgage at just over 5, like maybe 5.1 or something like that. So I went from 6.5 to 5.1, which is a significant savings on a $1.5 million mortgage. I think I'm saving like $400 a week, kind of thing. So my thought process there was, and by the way, this mortgage is not with an A lender. It's like with one of those kind of I'll call them, it's not quite a B lender, but it's like an A- lender. It's one of those monoline lenders. So I thought to myself, like, what are the rates what is the best rate I think I can get with this lender? And you know what, when I ran the numbers and I did some research and some crunching, I thought, you know what? Probably if I really got a great rate, I would be at like 4.5, 4.75. And the odds of me hitting that, the probability, and you're the one who taught me that, is, to assess the probabilities of something. And I thought to myself, the probabilities of me striking it just right, whether I renew for a year, 3 years, or 5 years, that I'm going to go from that 5% to 4.75, and I'm going to agonize over this damn decision for just a court for 25 basis points. I just thought to myself, you know what? I'm happy with this. I'm going to protect the downside. I'm just going to lock it in for 5 years because I'd already realized those savings from where it was. So, anyways, that's my thought process on this one mortgage that just had to renew. And I think that, these are the kinds of stories investors are grappling with on a day-to-day. That's for sure.
It's not easy, and even homeowners. I mean, but at least from a homeowner point of view, you can get some decent rates. I mean, I've said, and I've talked to many, and I'm saying if you can get, like if you get 399, 389, somewhere in there, anything in the high threes or even a low four, you might want to consider taking it in if you're going for a fixed rate. That's, for me.
And those are the rates that are out there right now, Patrick, especially for homeowners and investors. And this, I want to make sure investors hear this. If you're an investor and you have multiple properties and you're getting a mortgage at 4.5, 4.4, 4.5, 4.6, 4.7, like that's okay. That is the range of good investment. Like Patrick, from 2010 to 2020, the majority of my mortgages were somewhere between 3.75 and 4.75. And but people they're still attached to this. Oh yeah, but at one time I had a 2% mortgage. That's not happening, man. Forget it.
Yep. Move on.
All right, Patrick, let's talk about the fact that the Doug Ford government has called everybody back to the office. No more 3 days a week. Everyone's going back full time as of, I think, is it beginning of or late this year, early next year, right?
October. Yeah, in October they got to go back 4 days a week, and it's not just federal workers or provincial workers. It is, in fact, also a couple of big banks are doing it as well. So the point is there's going to be somewhere between, probably 80,000 and 100,000 people that are going to go back to the office.
Gosh, so I can't wait. I can't wait to see the highways. I can't wait to see the 401 in Toronto.
Well, think about the impact of this. So listen, I really get how this may make sense, but understand that there's going to be a fallout that I don't think the government thinks about this stuff. Ford I don't get the impression from Ford when he's speaking that he's giving this any consideration. He just does what he does. But the point is this: you're going to see. I think it's an effective way to thin or cull the herd. We've heard about both the provincial and federal government wanting to cut back public sector jobs. This is a way to do it without laying anybody off, because what's going to happen. You had a whole bunch of people that have been working at home, JG, and the lifestyle adjusted to that, their cost of living adjusted to that. And now they're saying, okay, you got to go back to the office. I think you're going to have a whole bunch of people that are just going, nope, I can't make the math work. I happened to be sitting with nieces and nephews yesterday, all young adults, 40-ish years old, all with children. We got into the conversation of daycare. So guess what? You're working from home. You've managed to, maybe you've got a 4 or 5-year-old, a 6-year-old, whatever. You've learned to and been able to manage their care at home. Now you've got to put them in daycare. I think perhaps when you start doing the math, a lot of people are going to say, I can't justify the drive, the cost of fuel and increased wear and tear on my vehicle, the cost of daycare for my children. I may as well just stay at home, quit my job, go on unemployment for a year, figure it out after that. I think that's what's going to happen. The cost of living is going to increase, and people are going to say no. And they moved away from the city. They moved away from the core. So now their commute's even longer, more difficult. So I'm not optimistic about what's going to happen. I think they will definitely call the herd.
Gosh, I think I'm thinking about those small business owners, though, that own the cafe, the donut shop, the sandwich shop, the dry cleaner. Like, I'm sure they're happy about this because those businesses haven't quite recovered, I don't think, since the COVID years now. And they're probably thinking, oh, this is going to be my recovery because all those people are going to come back to the city centers. Patrick, you and I have shown many statistics where the city centers are not nearly as popular or populated or busy as they once were before COVID?
Well, I think there's a couple things. Number one, I think those businesses that you just referred to, most of them are gone anyways. They were shut down,
They're
year
gone.
two, so they're already gone. So and I don't, I don't walk downtown Toronto, but I certainly see it in other centers, and a lot of those businesses are boarded up, and or big boxes have moved in. Like it's a total, the dynamic has changed. I think there's another side of it that we can't step over, which is, you see the headlines. At least I see the headlines. I see the news. I see what's going on in Toronto. I see what's happened with the influx of huge immigration, the cultural shifts that are going on, and yeah, I think the downtown core of Toronto is going to seize up, and that's maybe being a little extreme, but I think there's going to be a price to pay for that, and a lot of people just are going to shut it down. So from that point of view, I think you make a good point in that probably those who are renting office and have office space now, they can probably justify it. Maybe they think productivity will increase. I don't know about that. It'll be all data that we don't know until we see the data. But ultimately, will productivity increase? I don't know. We'll find that out.
Let me make a couple notes on this, Patrick. So as you know, we've been scaling up and growing Visture like crazy. I think we're probably at almost 40 employees now. It's been growing like gangbusters. So we're doing a lot of interviewing, a lot of growing. We're busting at the seams. I got to get more office space. Now I got to buy a new building. But anyways, beside the point, we've been doing a lot of interviewing. And one of the things at the interviews, and I've seen the transition. I've seen the transition from like a year ago to today. So a year ago, I had a lot of people asking me about work from home. Like, is this a work from home? Can I work from home? Can this be like a hybrid position? Like I've heard a lot of that a year ago. I don't hear that at all anymore. Now we make it super clear that a lot of our people do end up working from home in terms of like flexibility, but I make it super clear to people, this is not a work from home position. Like working at Visture is not a work from home. You're not working from your living room. There's an office. You're expected to come into the office and then you go do your job from there. So it's interesting, but I have noticed the trend where people used to ask that question, that was a desire. I'm not seeing that as much anymore. So I have noticed that little shift. The other shift I've noticed for sure is I'm getting a lot of people that currently have a job in Toronto or in the GTA, and they moved here during COVID and they now want a job here. They know they're going to be called back to Toronto and they're getting ahead of it. I've probably interviewed a dozen people, Patrick, where this was their exact, like I would ask the question, why do you want to work at Visture? And their answer was quite frankly, because you guys are local and I don't want to go to Toronto anymore. And I know they're going to want me to start traveling every day back there. And I don't want to be on the 401 every day. So I want to work somewhere local. So I've been seeing that coming for a while. So you're absolutely bang on for that, Patrick.
Yeah, I think that's the other side of it. Our numbers of unemployment, I don't believe any of them anymore. I think that, when we start to see how much of the workforce has just gone out of the workforce, they've been applying for jobs for a year in different sectors. They're not getting jobs. They just quit looking for jobs. So ultimately when we look at the unemployment, peaking I think Toronto's well over 8. And when you look at Canada overall, we're going to start to see some numbers later this year that I think will be truer. But right now, I mean, unemployment is in fact high. Employment is at its lowest ever. There's just not enough jobs, and people aren't hiring and businesses aren't expanding. This goes back to, what we keep beating the drum around, a lack of productivity and how what drives our economy, and the fact that we don't export commodities, the fact that we're not doing business. I mean, Carney, you look at even our federal government. I mean, I wanted to cut Carney some slack, but literally, what has he done since he's been?
I was going to ask you for our government update because you've been on the Carney train for a while. So, like, where are we at?
I've not been on the Carney train, but I thought I'd cut him some slack and go. I wasn't optimistic. I think he's just a more sophisticated version of Justin. But at the end of the day, the track record so far is, oh, geez, maybe we'll go back to work. I mean, he's been traveling the world. He's not winning the U.S. over. Trump excluded him from the recent gathering, if you will, of all of the other countries except for Canada. That's become a bit of a joke. So when it comes to what was happening with Ukraine. So at the end of the day, I think that, they've done nothing. So we can't be really optimistic looking into the future thinking Carney's going to shift this whole economy around. It's not happening. He's done nothing that I can really put a finger on that says it's going to have an impact. So that's what we're dealing with. So when we look at the unemployment, when we look at what's happening in housing, when we look at what's the lack of consumerism, most of it, by the way, is in Ontario. The real bad news is Ontario and British Columbia is slowly catching up to what's going on in Ontario. Our two biggest provinces are being hit economically. And, it's hard to be optimistic when you've got that stuff going on. This goes back to, however, in the real estate world, what does that mean for us? And a lot of what we're seeing that's going to catch up to us, JG, we talked about this for months and I've been shining a light on it, is we're now morphing into a new conversation, which is around the scenario of, are we actually overbuilding, and are we going to have a glut of real estate? And what's the consequences of what we've got going on with the MLI Select program, the overbuilding of multifamily units? It's all going to come up, and we're going to go through the next 2 or 3 years. Going to be really kind of interesting to witness as a lot of these multifamily units come online. So this is all to say that a lot of new policies and a lot of shifts in policy have to be worked on and shifted. I don't know that our federal government's going to do that.
What do you think, Patrick? What do you think? Like, let's get down to brass tacks on the overbuilding thing. Is that going to be an issue? Is it a concern? Scale 1 to 10, how concerned should investors be about this? And what is the timeline?
Well, let's talk about Ontario because that's really the worst of it, and it was the biggest, supplier when we look at the condo market. So all those dog crate condos that they have that are, and it's not just Toronto. You've got Hamilton, for example. I mean, that GTA was a real condo hub of dog crate condos. Everybody was buying, everybody was investing. Now, so think about that. The investor market has gone. It's shut down. So think about that. At least 30% of the condo market was driven by investors. They're gone. They're not coming back. So now you've got these dog crate condos sitting there. And so guess what that means? A lot of them are going to go on the rental market. Rents are going to come down. You'll start to see.
We're definitely already seeing that. We've been talking about that.
Yeah, we're already seeing that. They're going to continue to come down. So we've talked about that in the supply issue. So then what happened was a lot of developers trying to keep the lights on, trying to keep their staff going, trying to keep revenue coming in. What do? They start going into that multifamily purpose-built space, purpose-built rental space. And so now all of those units are going to start coming online over the next year and a half. So you're going to see a real challenge when it comes to the rental market and immigration. Yeah. Note to self, immigration's been cut back and jobs are declining because we need tenants that work, by the way. So that market in Ontario, in parts of Ontario, I don't want to just cover, take a brush and paint it all the same. You're going to see that market really over the next 2 or 3 years really be challenged as more units come online. So the thing about it is that you have to look at the data because the headlines are all about housing and the government supplying housing and all of the housing that's available, but it's not end user housing. So, it really is a purpose-built rental market that we're starting to see come online. So rents will get soft. So that'll be good for the economy. Maybe shelter costs will come down. Maybe that's good. But ultimately, it's going to be a real challenge for a lot of the developers and a lot of the investors that do, in fact, have units coming online.
Yeah, let me give a bit of a rental market update of what I'm seeing, Patrick, on this note, and then we'll move on to YouTube questions. But we talked about this a while ago, how rents are definitely softening up. Some places they're down $50, $70, $100. Some places they're down a bit more. I've been really kind of digging into this and watching our markets and watching how we price stuff and what it actually goes for. And the interesting thing is it boils down to two things. It boils down to the quality of the unit and I was going to say the location, but let's just lump it all together in the quality of the unit. The lower, how do I put this? As the quality starts to chip away, there's a accelerating effect on the rents getting lower. So anytime the location isn't perfect, okay, that's the rents come down a little bit. The paint isn't perfectly done. It's not freshly painted. That comes down a little bit. The floors are a little bit old. Comes down a little bit. The kitchen's 10 years old. It needs to be redone. Comes down a little bit. And so one of the things we're seeing is a big disparity. And I haven't seen this actually, in fact, in a very long time. I don't even remember the last time I seen this, but I have 3 bedroom units. Some of them I'm renting for 1,900, and some of them I'm renting for 2,400. That's a huge gap. And I wasn't seeing that. This has never been the case. A 3 bedroom unit always went for 2,200, 2,250, 2,300, maybe 2,400. But now what we're seeing is the really nice units that are brand new, beautiful, great location, lots of amenities. They're renting super top dollar. And then the rest really start to go down. And the stuff I used to definitely be able to get $2,200 for, now I can only get 2,100, 2,000, 1,950, especially if it's not great. So this is why it's so important for people and investors and homeowners to keep their places up to snuff, renovate, and put money back into your property. Because if you don't, this is where it really starts to hurt. Because if you used to get $2,400 a month in rent, and now you're only going to get $1,900, that's $6,000 a year in difference there. And maybe it just takes a fresh coat of paint for $1,500 in order to get that place to rent out. So you really have to be open to the possibilities of renovation. That's what I'm seeing right now, Patrick. Feet on the street.
Yeah, JG, you make some really great points and all that. First and foremost, as new units come on, if they're built well and they're designed well, like layouts are good, you're going to see the propensity for tenants to say, "I want to live in that new unit." So if you've got an older unit and you haven't been able to maintain it, or you haven't maintained it, or weren't inspired to, guess what? You're going to have some challenges if it's not upgraded, renovated, maintained really well. But here's the other issue, JG, and this is why this market is it's on the precipice of the divergence of challenges that are going to show up. The access to capital, so liquidity, is going to be an issue for those individuals who have not been renovating or kept their properties up. Now, to compete, they're going to have to do that or drop their rents. But if you've got no liquidity, if you don't have access to capital, how do you put 100,000 or 50,000 or whatever you need into? Let's say you've got a fourplex or even a 12-unit building. Let's just say a 12-unit building that you've got to upgrade units. Where are you getting the cash from to renovate?
This is actually the crux of my point, Patrick. If investors would have the willingness to keep their places up to date and put money into it year over year over year and stay on top of it, then you don't have to do the $50,000 or $100,000 reno, because you've done it every single year. And a lot of investors think, if I don't have the money to put into it, I always tell investors, listen, you're going to have to put that money in. One way or the other, that money's going into that property. The question is do you want to pay $100,000 in 5 years from now? Or would you rather put smaller increments along the line? But no matter what, that place needs money, or get rid of it and sell it. But, that's the reality.
Well, so there's the entry point that we talk about, is Canada's real estate crisis. Is it a crisis, or is it an opportunity? And of course, for some, it's a crisis. For others, it's an opportunity. Because to your point, if you're 5 years or 10 years in and you haven't been keeping your buildings up, you haven't been managing your cash flow, you are not solid, or you've over leveraged, which many have, how are you going to update that unit? So you're now going to have to get from underneath of it. So what are you going to do? You're going to sell it, and there's lots of deals that are going to be out there for those who want to take the time to look for deals. That's the reality of it, is that you're going to see lots of opportunity in this particular market. But it's going to be harder work, and that's why most investors are just going to go away. There's going to be those that are a little more sophisticated, can see the future, aren't being driven by the emotions of today, and are looking 2 or 3 years down the road. Because I think this cycle, in most of them, is going to be, in terms of a real hard cycle, I think it's going to be another couple of years before we start to see a shift. Depends on what region you're in. You look at what's happening in Alberta. Calgary's gotten soft. Edmonton's getting into that slump cycle, but I think it's going to be quite short-lived. Edmonton potentially has will be an overbuilt situation, as is Calgary right now, for the shorter term, because Alberta economically, that is still a strong economic engine, and it will continue. But it's going to be a little bit soft for the next couple of years as we go through this part of the slump cycle again. So that's all to say, lots of opportunities showing up for those who want to take the time to learn, to educate themselves, are willing to do their diligence, and stay up to date with what's going on economically. And I think you can stay ahead of the curve. But there's still going to be a lot of pain for many who got in without that level of sophistication, without the education, who just borrowed, threw money up against the wall to see what stuck, listened to their brother-in-law because everybody's getting rich in the condo market. That is going to be very painful. And we haven't even really fully felt the pain or watched the pain of many that they're going through. I mean, there's lots of it going on, but it will continue to get worse over the coming probably 12 months.
Patrick, let's talk about YouTube comments. We've been getting a ton of comments. First of all, thank you everyone for commenting. Some of your comments make us think. Some of your comments make us laugh. Some of your comments, get us chatting.
Scratching head.
Yeah, scratching heads. We're just picking random comments. We're gonna have conversations about it. We're gonna do this more often. This is the first time we do this, but hopefully we do it more often. So keep the comments coming. Like, subscribe. Please put the comments in. You agree with us? You don't agree with us? That's okay. We don't care. Put the comments in. It's good for everyone to have this conversation. So Patrick, let's jump into some comments here. I like this. I'll start with this one. I am a renter and I won't buy until prices drop 80%. Good luck with that, Corey. If it doesn't, who cares? I will enjoy my life and live stress-free. I think that's awesome. I was like, when I read this, I was like, this is perfect. Now, the finishing thing is, I'll make myself rich instead of the bank. Perfect. Nothing wrong with that. That's great. If you have a different way to do it and you want to, and a lot of people, Patrick, and this is we talked about this, we've talked about this on previous episodes, like we are, I was going to say slowly, but it's not even slowly. We are quickly becoming a renter nation where the Canadian dream to own a house is really not, it's not there anymore. That people don't really care about owning a house. They want a great place to live. They don't necessarily care if they own it. They're happy to pay rent. Look at what Corey is saying. And that's great. Nothing wrong with that, Patrick.
Well, it's something interesting that we didn't touch on, but I just want to hit on it, is a lot of, as we know, a lot of parents were gifting down payments to their children to be able to afford a house. Got it. Good move, perhaps. But here's the thing. A lot of those parents were tapping into their equity vis-a-vis a line of credit or a HELOC. And so they're scratching a check off their HELOC for $100,000 or 200 or whatever the number was to actually come up with a down payment for the kids. The deal was that the kids would then, they'd either gift it to the kids or the kids would ultimately come back and pay it on a low interest rate. But guess what? Lines of credit, what are interest rates on lines of credit now? I don't even know, but are they north of 5 or 6%?
Yeah, they're just over 6. I think I checked mine the other day. It was like 6.5 or 6.7%, something like that.
Yeah. So guess what? All those parents that were borrowing money at 3% to fund their children, that's another aspect of it. So all to say this is that the affordability issue and, to the degree that people can see it is, it is going to be a renter nation. I just didn't want to step over that. But on to comments. One other comment, Gigi. If you're still with us and you've watched the show, tell me where I am. Put it in the comments. Look at my background.
Yeah, I was going to ask you where it's real. Is it? It's not a green screen, is it?
Not a green screen. Not a green screen, dude. So this is a very, very well-known view in this particular city in Canada. Put in the comments, where do you think it is? And
well, Patrick, it's a little bit like cheating because people know that you're Mr. Alberta and people know that you don't really cross the line over into Ontario. Like you hang out over there. So I think it's kind of like you just cut the country in half at least, if not a third. So I don't know. I mean, I just feel like it's not very fair.
That's a pretty good hint, though, JG.
Let's do one more comment, Patrick, because I want to do one more comment. So ZIRP for years, ZIRP stands for zero interest rate policy, for years should be taking account for the house prices. So maybe it's not the bottom yet. Add the micro factors and stagflation. So the conversation is really about whether or not a lot of people talk, a lot of comments are around how much, a lot of people think we're going way far down. The prices are going to move way more down. A lot of people think that, or at least they want them to. I don't know if they think they are, Patrick. I don't know if they just want them to so they could buy. I'm not sure. I haven't figured it out. But a lot of opinions are that prices will move way further down, meaning wherever they are now, they're going way more down. Some person, another comment was saying 80% more to go. I mean, I don't know about that. That's pretty crazy. But that's one thing. And so I guess let's have that conversation around whether or not we're at the bottom, whether or not you think we're at the bottom, whether or not how much further you think there's room to run in terms of going down. What are your thoughts?
Okay, here's my thoughts on it. Just looking at some of the data and kind of, a little bit of critical thinking or first principles maybe. But at the end of the day, JG, here's what we know: the condo market is going to continue to crash. It's going to go down even further. It's a full on meltdown, whatever language we want to use. So let's take the condo market let's take it right out of the equation. Then developers, builders, in order to make the math work, have to go to something that will drive business and drive cash flow, which is the multifamily space. And that was driven by CMHC's MLI Select program, 5 and 10% down and 50-year amortizations and blah, blah, blah. So that part of it. So let's look at where prices are not going to come down. So if you want to look and play in the condo market, you'll probably be smart to hang on and buy a great deal if you want to live in a condo. Awesome. Townhouses, same kind of scenario. Lots of pre-builds went up. Lots of mistakes got made. If you are an end user homeowner, you're going to buy a detached property, then that's where prices are not going to come down. So they're just not building them because all of the focus of the developers and the builders is on the multifamily space, purpose-built rentals. And of course, the condo market is shut down. So that's where the opportunities are going to start to show up.
Well, and you know what, Patrick? So I just want to summarize what I hear you saying, and I just want everyone to anchor to this, which is it depends on a few factors, one of them being the location. What happens in Alberta is very different than what happens in Ontario. It's very different what happens in BC, very different than happens in Quebec. But even within the provinces, what happens in Huntsville, Ontario is very different than what's going to happen in Red Deer, Alberta, which is very different than what's going to happen in Abbotsford, British Columbia. So the location and the specificity of the region is critical, and it never ceases to amaze me that people don't know that. People just they blanket all of real estate with one paintbrush, and that can't happen. The second thing is asset type, Patrick. You're right.
Property
Condos
type.
versus town. Yeah, property type, right? It's very, very different. And so the answer is, no matter where you think real estate is going, when you paint real estate with one brush, you're 100% wrong. You're going to be wrong, guaranteed. Every single time. You have to look at the regionality of it. So, if you're seriously considering real estate for whatever reason, then you have to look at the region, you have to look at the property type, you have to look at the economics of that particular area. And the other thing, Patrick, in a couple of comments, I saw people refer to us. I don't know why, but one person in particular referred to us as brokers, like we sell real estate. We don't sell any real estate. Just so we're super clear here, folks, we don't have no horse in this game. We don't sell real estate.
Yeah, and I think that's important. When we work within our own RAIN community, we're giving data. We do not benefit from you buying or selling real estate. We're here to provide our view of it with it's unbiased, because we literally don't win if you sell or don't sell or buy or don't buy real estate. We're here to give you the economic updates. We're here to teach you and give you some insights into how to invest in real estate and why you might want to invest in real estate. But ultimately, we don't gain. So we are pretty unbiased. Our opinions are our opinions.
All right, Patrick, what a fantastic episode. We covered the government ordering people back to work, the CPI, the cost of living, whether or not there's an overbuilt situation coming down the pipeline, and so much more. Thanks for an awesome episode, Patrick.
Thanks for leading the way, JG. If you enjoyed this episode and you want to hear more of what JG and I have got, check out our last episode. It was epic.